So you've got some money. How do you know whether you should invest it, save it, or use it to pay off debt like a mortgage or credit card? I'm going to show you my simple 3-step formula for answering that question and take you through some real life examples, like buying a house in cash versus paying an 8% mortgage. Step 1 is to consider the interest rates on each option. When they're close, step 2 comes into play, but when they're not, the higher rate option is usually better. If you've got a credit card with a 20% interest rate, there's almost no better investment you can make than paying it off. If you've got a mortgage at 3%, there's almost no worse investment you can make than paying it off. I'll cover both of those examples in greater detail in a few minutes, but first, let's start with the basics. The number one most important concept to understand when making this decision is that when you pay off debt, that is the same thing as a guaranteed rate of return of whatever the interest rate is on your debt. Here's a quick example so you can see how it works. In this example, you've got $10,000 in your bank account and you owe $10,000 on a car loan at a 5% interest rate. In option 1 at the top, you decide to pay it off. You don't owe any interest, but you also don't have any investment or savings to make you any money, so your debt is gone immediately, and 1 year from now, you're still even. In option 2 at the bottom, you decide to invest the money instead. So in the middle, you can see you shifted your $10,000 of cash into a $10,000 investment. Let's call it a 1-year bond with an interest rate of 5%. Well, 1 year from now, you're going to owe an extra $500 of interest on your loan, but you also would have made an extra $500 on your investment. So either way, you end up at the same place. This example was easy because the interest rates were both guaranteed and they were both the same. However, if it were always that easy, I wouldn't be making this video. When one of the returns is not guaranteed, like when you're considering investing in the stock market, that's where step 2 comes in. Ask yourself, how sure am I about getting each interest rate? We learned in step 1 that higher interest rates are better than lower ones, obviously, but the key point of step 2 is that guaranteed interest rates are better than rates that are not guaranteed, like a 10% long run expected rate of return on the stock market. I'll share 3 examples to bring this to life. First, why did I say that paying off a high interest credit card could be one of the best investments you can make? Second, why did I say that paying off a low interest mortgage could be one of the worst investment decisions you could make? And third, what happens when you have to choose between a lower rate that's guaranteed versus a higher rate that's not? The first 2 are easy. Why would paying off a credit card at a 20% interest rate be one of the best investment decisions you could ever make? Well, because you're earning a guaranteed 20% return. How likely are you to make over 20% on your investments? Not likely. Oh wait, no, but you bought Bitcoin. You're the only one that knows about it. So maybe you'll make over 20% a year. And why would paying off your 3% mortgage be one of the worst decisions you could make? Because as I'm filming this in mid 2024, you can earn a rate that's both higher and guaranteed in a CD or short-term treasury bond. Any amount you pay over the minimum is just throwing away free money. If rates go down to 1% in a couple years, the calculation might change, but as long as you can choose between 2 guaranteed rates of return, the higher one is always better. Also, keep in mind that mortgage interest is tax deductible up to a point, so the effective interest rate you're paying is often lower than it seems, since you'll likely get some of that money back on your tax return. Where it gets more complicated is when the guaranteed rate from paying off debt is only a little bit lower than the not guaranteed rate from investing. Here's a real life example from a friend of mine who's considering whether to buy a house in cash or pay a mortgage, which in mid 2024 would probably be in the 7 to 8% range. For this, we need to consider steps 1 and 2 together. What are the interest rates and how confident am I in each of them? The decision was easier when mortgage rates were at 3% because the expected long-run investment return was so much higher. Sure, the long-term investment return isn't guaranteed to be 10%, but the odds of earning more than 3% over 30 years are really high. How high? Well, since 1936, the S&P 500 has never returned less than about 9% in any 30-year period. So what if your mortgage rate is, say, 8%? That's a lot closer, but I still think it makes more sense to invest the money. The first reason is, like I said before, mortgage interest is tax deductible. There are some limits to how much is deductible, but for most people, it's most or all of it. That means that some of the interest you're paying on your mortgage might be coming back to you when you file your taxes. The second reason is that interest rates are likely to come down in the next few years. And if they do, you'll be able to refinance at a lower rate. So it's not really comparing a guaranteed 8% versus an uncertain 10%. That would be a much tougher decision. It's more like a guaranteed 8% for a couple years and then maybe 4 to 6% the rest of the time versus an uncertain 10%. Do we know interest rates will come down? No, technically not. And we certainly don't know by how much. But it's highly likely that they will. So every investing versus saving versus paying off debt decision comes down to a trade-off, but they all can be decided by factoring in these first two steps. What is the difference in interest rates, and how certain am I about each of them? Higher rates are better, but guaranteed rates are also better. Paying off debt is always a guaranteed return of the interest rate on that debt. Many things you'd use for savings, like a CD or short-term treasury bond, also offer a nearly guaranteed rate of return. Investment returns from the stock market are never guaranteed, but just how not guaranteed they are depends on your time horizon. Short-term stock market returns have a much wider potential range of outcomes than long-term stock market returns. So the longer your investment horizon is, the more confident you can be in earning something close to an 8 to 12% annual return in the stock market. It's never certain, but more and more likely the further out you go. Now, you're probably wondering what step number 3 is, and this one comes into play more when you're choosing between saving and investing. Let's say you've been living paycheck to paycheck, but you just got an inheritance, or you just started a new job where you're making a lot more money than you used to, and you want to know where to start. In this case, it comes down to your priorities, but savings should usually come first. Savings are just money you set aside for an emergency. It's the ultimate safe short-term money because you want it to be available at any time and you don't know when that might be. The general rule of thumb is to have between 3 to 6 months of your base expenses in savings, depending on what makes you feel most comfortable and how hard you think it would be for you to find another job. Of course, I'm assuming you won't need to be dipping into your savings if you don't lose your job, but if you might have big medical bills, home repairs, or some other large one-off expenses popping up, you'll want to factor those in too. I think it makes sense to build up savings first because, well, that's for an emergency. I hope you never have one, but if you do, it'll be nice to have peace of mind that you know your finances are set up for it. As your spending increases over time, your savings should increase over time. But once you've built up enough savings to cover you in an emergency, then the rest should go to investments. So there you have it. 3 simple steps to decide between saving, investing, and paying off debt. Number 1, what are the interest rates? Number 2, how certain am I that I'll get those interest rates? And number 3, am I comfortable with the amount of savings I have? Oh, and by the way, here's a bonus 4th consideration. Everything I've told you up to this point is the mathematically correct way to think about it. That will lead you to the highest odds of having the most money left over in the end, while making sure you're protected in the case of an emergency. However, people are not robots. Some people just simply do not feel comfortable with debt. It's hard to put a price on your sanity. So if you've got a loan at a 5% interest rate, and you could probably earn 10% by investing, but you'll sit there agonizing over that debt every day until it's paid off, just pay it off. It may not be the statistically most optimal thing to do, but there are definitely worse things you can do with your money than paying off debt. In a similar vein, the investment comparisons are all assuming you will actually invest the difference. You know yourself better than anyone, so will you? If not, then paying off the debt is probably the way to go. If this is your first time here, this channel is meant to teach you professional level investing education. You won't see clickbait or sensationalist headlines on my channel. I am a former investment advisor to portfolio managers at Merrill Lynch and Morgan Stanley, and I've partnered with someone who's currently still in the industry and is a CFA charter holder. So if you feel like this content is a little bit more advanced or explained really well, there's a reason behind that. If you have any questions, let me know in the comments below. And just so you know, we have a free Discord with over 100 people, maybe 110 now. You can join that by clicking the link below in the description. Thanks for watching, and I'll see you in the next video.